when you look at the valuation of public companies, is there a threshold that as a long-term investor of what's historically expensive or in the danger zone? Some companies trade in today's market at 20 times free cash flow or even 40 times.
Well, I mean, I don't look at the market in terms of a level. I look at the macro markets in terms of prevailing conditions in rate of change terms. That shouldn't sound like a lot if you're competent at doing this, and if you don't know what rate of change means or prevailing growth and inflation conditions means, you should not be doing this. Again, if the rate of change in real growth is accelerating, you will see multiple expansion, and if you think that you're selling at the right level because you're Benjamin Graham or whoever, Benjamin Franklin told you what the right level was, you're going to be wrong until growth slows, or at least the acceleration slows. Now that to me is the most important lesson of macro market history, is that you really have no idea. I mean, at the end of the day, in 1996, so for example, this morning the Wall Street Journal was identifying stocks as expensive at 19 times trailing earnings. 19 times trailing earnings. I mean, you could have bought the S&P 500 at 20 times trailing earnings in 1996. You would have had to say they're more expensive in 1997 at 22 times, and then in 1998 at 28 times. And then by 1999, you were well over 30 times trailing earnings. Now, that was expensive in 1999, but the economy also slowed in 2000. That's what got the multiple compression. It wasn't that all of a sudden God called with a multiple. I mean, that's not, I'm more, and so that's how I'm focused on it from a multiple perspective in macro markets. Now, how I look at a security, or a stock specifically, and I think this is a really important part of your question, is that if something's trading at 20 times free cash flow, and our projection from an analyst perspective is that the free cash flow is done expanding, well then that's a good short, because it's not because of valuation, it's because the cash flow is going to be slowing. So now you got a stock that's priced at a huge multiple on a cash flow base that is going to drop. Now that is an expensive stock. That is just a complement to the catalyst. So a good example of that, a stock like that today is actually Sabre Group, S-A-B-R. Our analyst, Ami Joseph, has been talking about the valuation of Sabre, but the structural problems Sabre faces going forward, and unless they change that to maintain their cash flow, they'd have to restructure. That's precisely what they did this morning. But the stock was trading on a non-restructuring base of cash flow. So I mean, now the stock's going to correct because now people's forward outlook on the cash flow is lower. So again, think about rate of change across the board in your life in terms of your weight, and your height. At some point, you're going to realize there's a terminal value to your height. But when you think about all these different things, you got to think about the rate of change. Where you've been to where you're going next. What is the multiple going to do? If you're going that way next, it's going to go up. If you're going that way next, it's going to go down. And really, there is a spot for private equity on the low end at 3, 4, 5 times, 6 times cash flow. I've done it plenty of times in my career. I worked at Carlyle, don't forget. I was trying to get them to do a bunch of this stuff. But again, at the end of the day, our relationship didn't last too long. But the point is that a certified monkey can buy an asset at 3, 4, 5, 6 times cash flow if they own the duration of the asset. So if I'm Warren Buffett, that means in 3, 4, 5 years, I get my money back, in terms of what I paid for it and what the business generates. So I get that. I understand that. But that has nothing to do with calling the NASDAQ too expensive that you couldn't buy it this year. Absolutely nothing. That's different. Actually, one more slide on this now that I'm ranting, or at least providing a bit of a tutorial on this. I believe we have this slide in the deck on technology. Now, is tech expensive, or is Wall Street just whining about it? Having missed it, I think, is more the point. Slide 39, Josephine. For those who want to talk cheap versus expensive, and you'll often hear that tech is expensive, that's a lie. I mean, that's just a lie. I mean, I don't know how else to say that. I mean, you characterize it any way you want. So what we're looking at here is the next 12 months PE multiple of all the sectors relative to both the S&P 500 and relative to itself. As you can see, the most expensive sector relative to itself are actually two of the worst performing sectors in the market, utilities and energy. So if you want to talk about expensive stocks, why don't you talk about the ones that nobody's talking about as expensive stocks? So again, when you look at the multiple versus the last 30 years of multiples that the subsectors have had, tech is not expensive. It's in the 64th percentile versus where it's been. Now, when you look at it relative to the market, which is the chart, this thing is nowhere near expensive. I mean, in 1999, it was mother something expensive. In 2006 and 7, when I was getting bearish in 07, it was very expensive, but not as expensive as it was in the 1999 bubble. Right now, it's nowhere near as expensive as the prior two bubbles that I appropriately risk managed. Don't forget, I've never blown up on the downside. And I've never missed a market move on the downside. I fully intend on getting the market move to the downside, and if I thought that valuation was a catalyst for that, I would say that.